Welcome back. February 2026 has been, observationally speaking, one of the most educational months in recent crypto history. We've watched Bitcoin fall from its October 2025 all-time high of $126,000 all the way down to a low of $60,033, a drawdown of over 52%. Along the way, we've seen liquidation events ranging from $223 million on quieter days all the way to $2.6 billion in a single 24-hour period on February 6th. But today, we're zooming in on one of those mid-tier events, the $223 million snapshot, because it tells us something really important about how this market works at a mechanical level. Let's get into it. Segment 1. What is a liquidation? 1. 2:45. Graphic. Simple diagram. Trader deposits $1,000, borrows $9,000 at 10x leverage, holds $10,000 BTC position. Price drops 10%. Exchange closes the position. Host. Before the charts, let's define the term. A liquidation in crypto happens when a trader using leveraged futures or perpetual contracts runs out of margin. The exchange automatically closes their position, forcibly, to prevent further losses. Here's a simple example. Say you deposit $1,000 as collateral and open a 10x leveraged long on Bitcoin. You're effectively controlling $10,000 worth of BTC. If Bitcoin drops just 10%, your entire $1,000 is wiped and the exchange liquidates you, automatically, instantly, no questions asked. Now multiply that by tens of thousands of traders simultaneously. That's a liquidation event. During February 2026, according to CoinGlass data, we observed over 335,000 individual accounts liquidated on February 1st alone, a single day. The structure of the month made events like the $223 million snapshot feel almost routine by comparison. Graphic. Pie chart. 223 TETH total. Bitcoin, 90 banters, 40.4%. Ethereum, 65 MALs. Altcoins, 68 ETH MALs. What stands out in the $223 million breakdown is Bitcoin's $90 million share, roughly 40% of total liquidations concentrated in one asset. That's Bitcoin's gravitational pull on the derivatives market in plain numerical form. Segment 2. The price drop. Reading the chart. 2.4505A. Graphic. BTC price chart. October 2025, 126K ATH. January 2026, 90K range. February 1st, 74, 662. February 6th, 60,33. Host. Let's walk through the price action that created those liquidations. In October 2025, Bitcoin hit its all-time high of $126,000. Through November and December, price consolidated between $85,000 and $90,000, a range many traders were watching closely. Then, January ended. On February 1st, Bitcoin crashed to $74,660, its lowest level since the April 2025 tariff-driven sell-off. That single move triggered over $2.5 billion in liquidations across the market. By February 6th, BTC had pierced $60,000 intraday, briefly touching $60,033 before rebounding. Graphic, annotated chart. Key support levels marked at 90K, 82K, 76K, 70K, 60K. What the chart shows us is a staircase of broken support levels. The 50-day exponential moving average near $90,000, which had acted as support, flipped to resistance. Support at $86,000 failed, then $82,000, then $76,000. Then $72,900, a 14-month low hit on February 3rd. Each support level breaking wasn't just a technical event, it was a trigger, and that brings us to the concept at the center of this video. Segment 3. Stop-loss hunting. Explained. 5:40 it's 8 hours. Graphic. Annotated price chart showing clustered stop-losses just below round numbers, 90K, 80K, 75K, 70K. Host. Stop-loss hunting. It sounds conspiratorial, but the mechanics behind it are actually observable in the data, and February 2026 gave us a textbook case study. Here's how it works. Traders set stop-loss orders below key price levels, round numbers, previous lows, support zones. If you were long Bitcoin at $85,000, you might have placed your stop at $79,500, just below the psychologically significant $80,000 mark. Tens of thousands of traders think the same way. That creates a dense cluster of stop orders sitting at predictable price zones. Now, when large sell orders enter, whether from institutions unwinding positions, ETF redemptions, or over-leveraged traders getting squeezed, prices move toward those clusters. Once the first stop triggers, it creates sell volume. That sell volume pushes price lower, triggering the next cluster of stops. That creates more sells. The cascade feeds itself. Graphic. Step-by-step cascade diagram. BTC hits 80K, 500 meters in stops triggered, price drops to 78K, another cluster triggers, drops to 76K, etc. On February the 2nd, CoinDesk reported that more than $500 million in leveraged long positions were liquidated over a thin liquidity weekend as Bitcoin broke below $80,000. The options market showed a rapid surge in demand for $75,000 put options, traders scrambling for downside protection after they'd already been hit. The important observation here is this: the liquidation data doesn't just show how much was lost. It shows where the market was structurally weak, and those weakness points were mapped in plain sight on every liquidation heat map published on platforms like CoinGlass, weeks before the drop. Graphic. Liquidation heat map example. Dense red clusters below 80K, 75K, 70K. Liquidation heat maps work by aggregating estimated stop and liquidation levels across exchanges. The densest zones on those maps, the brightest colors, represent the highest concentration of leveraged exposure. Observationally, February's price action moved with striking precision through those zones, layer by layer. Segment 4. Who got hit? 8. 9. 30. Graphic. Long versus short breakdown bar chart. Longs, 180 meter. Shorts, 43 meter of the 223 event. Host. In the $223 million liquidation event, the overwhelming majority, roughly 80%, hit long positions. Traders betting on higher prices. That ratio tracks with the broader February trend. CoinGlass data from February 6th's larger $2.6 billion event showed $2.1 billion in long liquidations versus just $468 million in shorts. This asymmetry is observable and consistent. Entering February 2026, the market was carrying a structurally long-biased derivatives book, meaning most leveraged bets were on the upside. When the trend reversed, those longs became the fuel for the cascade. The single largest liquidation order during the broader February downturn was recorded on Binance. A $12 million BTC position closed automatically. On Hyperliquid, a decentralized exchange, a $36.78 million BTC USD position was wiped in a single close. These weren't small retail accounts. The leverage problem existed at every level of the market. Segment 5. The macro context. 9:30:11 How? B-roll, news headlines, Fed policy, global equity sell-offs, Bitcoin ETF outflows. Host, liquidations don't happen in a vacuum. The February 2026 cascade occurred alongside a broader risk-off environment that analysts at the Kobeissi letter described as resembling systemic position reduction rather than a normal correction. Bitcoin ETFs saw $903 million in net outflows on February 5th alone, the second largest single-day outflow since spot ETFs launched. CoinShares reported year-to-date outflows totaling $1 billion by early February, citing what their research head, James Butterfield, called a marked deterioration in investor sentiment. The Fear and Greed Index dropped to 9 out of 100 on February 6th, its lowest reading since the Terra Luna collapse in 2022. Bitcoin's market capitalization, which had been $1.29 trillion at the height of the cycle, was shedding hundreds of billions in real time. What makes the $223 million snapshot valuable as an educational moment is that it sits in the middle of this larger context. Not the extreme chaos of a $2.6 billion day, but not normal either. It's what the market looked like when it was between cascades. Even on a relatively quiet day, $223 million in positions were being forcibly closed. That's the underlying leverage level February inherited from the bull run. Outro, 11 to 12 TLs. Host on camera or graphic summary points. Host. So let's pull this together. The $223 million liquidation event, with Bitcoin accounting for $90 million, is a snapshot of three observable mechanics working simultaneously. First, leverage compression. Positions built during the bull run were structurally fragile once price direction changed. Second, cascade triggers. Each broken support level activated a new layer of pre-placed stop-loss orders, mechanically pushing price through the next zone. Third, market asymmetry. The long, heavy derivatives market meant downside moves were turbocharged by the forced selling of the majority. February 2026 has been a case study in how liquidation mechanics interact with price structure. The data, the heat maps, and the charts all told the same story, and they were all publicly available before the events unfolded. Understanding how these events work is fundamentally different from predicting when they'll happen next. But observationally, the patterns are there for anyone who looks. If you found this breakdown useful, subscribe for more market structure analysis. Drop any questions in the comments below. See you in the next one.